Money Show.
Personal Finance with Warren Ingram.
Well, you may want to pay particular attention to personal finance tonight as we have officially started January as the December spending spree is over. Warren, good evening. Happy New Year. I think a lot more listeners for you tonight.
Thanks so much, Stephen. It's great to be on the show, and I'm looking forward to cracking 2025.
Let's hope it's financially successful. You make the point that you've got to start on the right footing. You've got to set the tone for the year. And a big part of that, of course, is setting goals. How important is setting goals?
Well, often when you speak to people about their money at the start of the year, you get a sense of hopelessness about their finances. As you say, a lot of people call it January, and they're afraid and kind of starting a year on a bad cycle where they're concerned about debt, or they're concerned about having no money, and it's the beginning of a year. And to me, that's not the best way for us to get ourselves going. And I always think, if we rely on kind of drifting from month to month, year to year, then what you have to know is you're not going to end up where you want to be with your finances and potentially with the retirement or financial freedom goals that you're aspiring to. If you don't set a goal, how on earth are you going to go anywhere? And I think that's maybe the first point for the year is just sit down and spend a bit of time quietly setting some goals for yourself. And I'm not saying that there have to be massive goals. If you're 35 years old, I'm not saying, set the goal to say, I'm going to retire by 55. If that's what you want to do, great. But why not set some smaller milestones, slightly more achievable things that you can get done in a 6-month or 12-month period, and put them down, put them into action. I think for me, a lot of the time when you speak to people that are struggling with their money, they don't really have a plan. They don't really have a goal. They're just drifting from month to month, from paycheck to paycheck, and stressing about bills without ever really taking control. And for me, step one for control is set some goals.
You talk about setting goals. I mean, it can be quite simple, I suppose. It could be sorting out your emergency fund, things like that.
It has to be simple, Stephen. It's what I do every day, and it can't be complex. Otherwise, they'd call it rocket science. So I think doing very basic things to take control. One of them is life is going to happen. There will be something in a 12-month period that will attempt to derail your finances, whether it's the geyser bursting at home and you need to pay the excess on your insurance, it's a little fender bender and you need to pay the excess on that insurance, or an unexpected medical bill that doesn't get covered by medical aid, or whatever it is. There will be an expense that you can't plan for and that you can't prepare for. And if you want to be sure of some control, then set up your emergency fund. And just as a reminder, I think the ideal number is somewhere around 3 months worth of your expenses to a maximum of 6 months worth of your expenses. So if you're spending 10,000 a month, then 30,000 a month to 30,000 to 60,000 is a good amount for an emergency fund, because by then, if you've got that amount of money set aside and something big happens, at least you can get going for a few months with your emergency fund while you make a plan. Most people, if they don't have an emergency fund, what they're doing is they're going into some form of debt, and it's usually incredibly expensive debt, something like a credit card or a personal loan or an overdraft or even a loan shark, and that's not going to help you get to financial freedom. So it can be really simple, build your emergency fund. If you do that in the next few months, that gives you massive control and makes you kind of immune from what will happen in life. And it's amazing, Stephen, how often, if you have the emergency fund, the emergency doesn't arise, but when you don't have the emergency fund, it arises the next day.
Isn't that always the case? Part of it is also, of course, about budgeting. And this is a really good time. It may not be very busy at work, for example, to spend some time budgeting. Where do you start? How do you do it?
I think first, I always, when I speak to an audience, I can see people's eyes rolling backwards, and kind of starting the yawns when I say, let's talk about budgeting. So I just want to address that. It doesn't mean that there is no fun and there is no return on life or enjoyment when you set up a budget. In fact, that might be the first thing that you put down in your budget is, I want to spend a certain amount of money every month on things that are fun and meaningful to me. And that's great. By by all means do that. I think, once you plan for them, it gives you the freedom to spend that money that you've set aside on those things. And you can set it up in a way that it becomes some form of a reward for doing the other things, which are a bit harder. So I think, budgeting shouldn't be a swear word, and it shouldn't be something that's boring for people. It should be something that allows you some form of excitement. And so to me, start the year by looking at what you've spent over the last 3 months. Most of us nowadays, we spend on our phones or tap and go, so it's pretty easy to get a good idea of what's happened in your finances and your expenses over a 3-month period. And I think the last 3 months is a very good indication, because December will probably be a bit more expensive than normal. If you've been on holiday, you've probably spent a bit more. November, maybe not so much, and October might have been the month that you were trying to prepare for December, so you might have underspent a bit. So look at what you spent over that 3-month period, and then get to an average. So again, if you spent 15,000 in December and you spent 10 in November and 8 in October, add them all together, divide by 3, and that becomes your average monthly expenses, and then see how you divvy that up. How did it actually work? Where did the money go? And that should be the basis for your budget going forward. And I think importantly here, don't set a budget that's unrealistic. In other words, don't say, well, I normally spend 20,000 a month, and that's ridiculous. I'm only going to budget to spend 15,000 next month, because that's not going to happen. You are going to spend close to what you spend on an average month. So maybe create the space to say, well, I need to save a little bit of money. So I'm going to, if I spend 20 normally, I'm going to aim to spend 19,500 and set aside the 500 for my emergency fund. Do it simply and do it basically.
One of the things, of course, is trying to make sure that you put money aside. Are there easy ways to do that?
Yeah, I think we don't. We're not disciplined as human beings. If we were, we'd all be marathon runners and eating incredibly healthy. But that's not the reality when we look around at ourselves and our friends and our peers around the country and the world. So there are things that you can do to instill some discipline that don't take much work. And one of them is this thing of an automatic debit order. At the start of a month, when if you get paid on the 25th, try and set up some debit orders on your accounts, the next day that run off your account immediately, so that you allocate some money to your savings. For example, if you need to bulk up your retirement fund, and you need to get your fund going and your emergency fund, then potentially take some money for each of those and run a debit order from your bank account the day after payday into each of those goals, so that you're not required by month end, when there's no money left, to try and find a way to fill those financial goals. It happens automatically, and then that once they're off your account, whatever's left is there to pay the bills and potentially to be spent, because you've taken care of the goals automatically. And I think there's a bit of friction involved here. Once we set up an automatic debit order, it creates a bit of work for us to go and undo that. So often what happens is we become a little bit more disciplined by default, because it just takes too much work and too much effort to undo that. And I like that idea. I like making it hard to stop saving.
I mean, I suppose, I like the idea of friction, because it really maximizes the utility of our laziness, to use a complicated phrase. It basically makes a virtue of us being lazy. You make it hard for yourself to stop saving, in other words.
Yeah, part of achieving financial freedom is an element of honesty with yourself. It doesn't matter what you tell the world; it really matters what you tell yourself. And if you know that you're a little bit lazy and you're not going to be disciplined in taking the extra money every month and setting it into your investments, then create this difficulty, this friction, where it becomes harder to undo your good habits and hard to spend the money on your bad habits, which maybe also leads to another point on this, which is, if it's easy for people to spend on a credit card, and on their phone, and that it's easy to go into debt, one of the things you should really be considering is reducing your credit limits on your credit cards, your overdrafts, all of those things. Nowadays, with fraud, so prevalent around the world, it makes a lot of sense to have a very small credit limit anyway, because if something goes wrong and you get hacked or you get defrauded, at least the damage won't be so big. But secondly, if you're not disciplined with your credit card, then having a very small credit limit means that you're not going to get yourself into so much trouble every month, because you've set in a limit, and again, becomes hard to change that limit. So I think those are simple things we can do to look after ourselves. And maybe just to stay on the point of debt for a second, if you are sitting with major credit card or personal loan or overdraft debt now, then some of the fun money that you might be wanting to set aside, you might need to just defer a little bit for a time, and get that credit card down to zero as fast as you possibly can, because credit card debt, unfortunately, compounds against you faster than almost anything else. And that's the thing you need to get out of your life as fast as you possibly can.
I suppose all short-term debt you want to get rid of, and this is a good moment to do it.
Exactly, and face the reality. Don't ignore it, and don't avoid the banking app or the bank statements when you get them. Stare at that problem in the face, understand it, and one of your goals might be, I'm going to take control of this. I'm not going to be dictated to by my debt provider. I'm going to take control, and even if there is not that much money in your budget, allocate a little bit extra into getting those debts down. And I think that sense of achievement, when you look at your statement every month and you say, well, I've knocked 10% off my debt, and you do that month after month, at some point the debt goes away, and that sense of accomplishment and achievement and pride is really valuable in helping you set new goals with a lot more confidence. So please don't ignore this stuff. It compounds against you really quickly, and no one forgets when you owe them money. They will always remember, and institutions will chase you forever. So take control and get rid of it.
We're speaking to Warren Ingram, the co-founder of Galileo Capital, 011 883 0702 021 446 0567. Your questions for him at the beginning of January. The other thing you need to do at this time, of course, Warren, is have a look at your investments. You need to make sure that the money you have put away has been invested wisely.
Yeah, I think especially when we've been through a period of time where investments haven't done too badly. The last 2 or 3 years, especially in the US stock market, have been extremely productive for a lot of investors. Even the JSE hasn't done too badly over the last couple of years. It's been quite rewarding. And so the temptation might be just to leave everything as it is, because why would you break something that's not broken? And that's not necessarily the best idea with investments. Unfortunately, when we look at the world of investing, the things that did incredibly well over the last year or two are not necessarily going to be the things that will do incredibly well over the next 3 or 4 years. And the reason for that is valuations. When you're buying a share like Nvidia, which is kind of the most hyped share around, because its chips are going to drive the artificial intelligence boom of the world, it might do that. But what we have to know is that the valuation of Nvidia, in other words, the price earnings ratio, is much more than 50 at the moment. That means 50 years of current profits to pay for the current price. That's an enormously expensive business. Now, it might do incredibly well for the next year or two, that share price, but it's extremely rare for a company that's so expensive to deliver great returns for the next 5 or 10 years. It might happen, but it requires a lot of luck. And so it's important to look at your portfolio of investments to say, perhaps it's time for me to make sure that I've got correct diversification. Have I got too much invested in American tech shares? Shouldn't I have a bit more in emerging markets? Shouldn't I have a bit more spread to bonds, etc.? So just make sure that the balance of your portfolio is correct, and then look at the spread between your local and global investments as well. If the rand is likely to go stronger, might find local investments doing well, and so make sure that you've got the ideal balance between what you've got in South Africa and overseas, and don't be disappointed then if you've got the balance wrong and the JSE and the rand do incredibly well over the next 5 years. That's a possibility. It's not a forecast, but it's a possibility, and the only way you benefit from that is proper diversification and a proper balance of your investments. And my last point on this, Stephen, is you have to stay calm when things get scary. There is every likelihood when you've got, President Donald Trump from sometime this month, and whatever is going to go on with conflicts around the world, potentially, interest rates not coming down so quickly in the US, that the news headlines will be frightening. And that's not the time to panic. You need to get your strategy right now, need to make sure the diversification is okay. And then when things do get rocky and do get bumpy, don't panic, because that provides the opportunities for you to buy the assets that other people are selling at a huge discount.
I suppose this takes us to another question. Is there ever a moment at which you do need to panic? And I'm reminded of what happened at the start of the pandemic. Some people panicked, lost a huge amount of money, and then markets rebounded really quite quickly. And if you didn't, and if that was the wrong time to panic, then it's never time to panic. But it can't really be the case that it's never time to panic.
I think the times that I can recall where it was worth a little bit of sensible panic was, for example, when the big Steinhoff story broke, when the big African bank story broke, going way back when a share called Enron, the news broke in the States. When an individual company that's been a star performer starts to hit the wall in a big way, and I'm not just talking about missing a profit forecast. Lots of companies won't achieve a profit forecast, but when you start to see real warning signs that there might be fraud, that their business case might be collapsing, that's the time for me to be a quick seller and don't be tempted to buy in again. I think I can't tell you how many phone calls I received from people once Steinhoff had halved in price to say, isn't the time now right to buy into that share again? And of course, the value went to zero. So I think when you own an individual company and reliable media starts to tell you that there are real problems there, real kind of end of business potential problems, that's a time to sell. And I don't think that's necessarily panic. I think it's probably sensible, rational response. But for example, when you look at a country, would you sell out of a country? Well, I mean, there might be a time if you think that there's going to, if you were Ukrainian and you knew that the tanks in Russia were kind of massing on your border, that might be a time to sell an entire country. But I think very rarely are there other situations where it's time to panic. I think, in a big market crash, by the time you know that it's all happening, it's actually already happened.
Yeah.
And then the best thing to do is to sit it out.
We're speaking to Warren Ingram, Personal Finance Tonight, co-founder of Galileo Capital. Good to hear from you as well.
The Money Show.
Personal Finance with Warren Ingram.
Warren, of course, co-founder of Galileo Capital. On that point about sort of global sort of geopolitical risk at the moment, Warren, we had a question from Katlego, who sent us this question saying, I'm so worried about Donald Trump, Elon Musk, and the booming artificial intelligence sector. I think there's a good chance the US tech sector is going to implode this year. How can I protect my investments from harm? I think when you look at the huge run that it's had, it's a legitimate question. I know plenty of people who will tell us that this run's still got a long way to go yet. But how do you protect investments in this situation?
I think you need to approach something like this with a huge element of humility, and the humility involved here is to say to yourself and to your money particularly that you can't forecast, you can't predict the outcome of what's going to happen over the next 6 months or 12 months. When we look at the articles being written by respected people trying to analyze Donald Trump, the summary, I think, of all of those articles is no one actually knows what he's going to do. No one actually knows what he's going to deliver and what he's going to bank on the promises that he made and what he's not going to bank. So I think if you want to be in the game of forecasting what politicians and wacky billionaires are going to do, I think you need to know you're probably going to lose money more often than you will make money. And then with something like the whole view on AI, it feels to me very similar to what happened in the late 1990s, where we all saw the power of the internet and how it could change the way business was done. The reality is that the companies that made real money out of it, from an investment perspective, were only really productive for investors about a decade later. And so the early, forerunners actually didn't generate a huge amount of profit for investors, and many of them went bang. So my answer to Katlego in a situation like this is practice some sensible diversification. I mean, I'm not sure that the shares that are exposed to AI, will stop growing this year. They might well continue to boom for another day or another year. I have really no clear view at all. But what you should do is, if those shares have suddenly become 20 or 30% of your overall portfolio, you need to know you're overexposed to a sector which is phenomenally expensive. And then don't be afraid of taking some profits off the table, allocating those profits elsewhere to other investments that are very cheap. And then you, by all means, keep some money allocated to those. I mean, if that sector continues to do well for investors for another 2 or 3 years, it will be nice and rewarding for you to have a portion, but always be sure that you've got a sensible allocation to a bunch of different sectors. And when we're looking at Trump, to a bunch of different geographies. We don't know what Trump's going to do for the US or for the globe. He might unsettle everybody and everything, and in which case, we might be in a major crash. I'm not convinced of that argument, but equally, I'm not convinced of the argument that he's going to be phenomenally helpful to all investors everywhere. I don't see that either. So I think just be very careful of the forecasts, be very careful of the scary headlines, because very often what politicians and big businessmen say that they're going to do and what they actually do are very different. Just don't forget, I'm going to build the wall and I'm going to make Mexico pay for it. Well, that didn't happen. So we don't know what's going to happen. So spread your investments and then stay calm.
We've got a minute and a half left, Warren. We heard commentary yesterday from people in the cryptocurrency industry, and this is a sort of Trump question. They want pension regulations, I think it's called Regulation 28 from our National Treasury, to change to allow South African pension funds to invest in cryptocurrencies. I presume you're not a fan of that idea.
I think someone made an observation the other day to say that Bitcoin's most enduring strength is that it just won't die after a very long period of time, and so it's faced a lot of headwinds, and it's come out the other side. Do I think that it's going to be the thing that will make all pensioners incredibly wealthy? No. Allocating 1% of a pension fund to Bitcoin at the right time and at the right price might be some form of risk management, maybe, but I don't think it's going to be the thing that will generate dividends and income for retirees and people building their wealth. So I'm not a big fan, but if they do it, they need to do it with an incredibly small amount of money.
Warren Ingram, thank you very much indeed. Always good to hear from you. Co-founder of Galileo Capital, and of course bringing you personal finance at the beginning of January.